curious minds, welcome to ProjexCellence ProDigy. In today's episode, we'll delve into the concept of project selection. We will explore the criteria organizations typically use to choose the most promising project from their options to ensure the profitability. In addition to the theoretical concepts, we'll also cover simple formulae and calculations to determine financial terms as PV, CBR, IRR, NPV, ROI, CBA. Project selection in a company's context can be similar to the decision making and goal setting in an individual's life. As individual makes decisions on how to spend his time, money, and energy to achieve his personal goals and improve his quality of life. Similarly, the companies evaluate and choose projects to invest their resources wisely. Let's go through its definition. Project selection is the process of evaluating and choosing projects that align with an organization's goals, resources, and strategic objectives. This process involves assessing various potential projects to determine which one should be pursued based on criteria such as profitability, feasibility, risk, and alignment with business objectives. Steps of project selection. Organizations go through these steps while choosing their potential projects. The very first step is to identify potential projects. You have to generate a list of potential projects from various sources as stakeholders, market analysis, or future demand. Let's assume here one energy company is evaluating the potential projects to expand its portfolio of renewable energy projects. So there are plenty of options available to start in renewable field. Suppose company has identified three options. Project A, building a new solar farm in a sunny region. Project B, constructing a wind farm in a coastal area. And Project C, developing a hydroelectric power plant in a mountainous area with a river. So in this first step, company has identified the potential projects. Now it has to choose one out of these three projects. For this, it will move to the next step. It will define the selection criteria. It will establish the criteria for evaluation of projects. So there will be variety of qualitative and quantitative factors which need to be analyzed. Other than the financial metrics mentioned here, a company will ensure that the project aligns with the organization's overall strategic goals and objectives. It will assess the technical feasibility, whether the project can be successfully completed with the current technology and resources. It will assess the potential risk and their impact on the project and evaluating the likelihood of these risks occurring. It will ensure that the necessary resources like human, financial, material are available for the projects. It will ensure that the project complies with all the relevant laws, regulations, and industry standards. It will assess the potential environmental impact of the project and it will ensure the sustainability. Company will evaluate the demand for the project's output or result in the market. So once this selection criteria is defined, the team will move to the next step. It will gather the information in detail against each of the criteria. Next step would be evaluate projects. So company will use a weighted scoring model. It will assign the score for each criteria based on the gathered information. The scoring will be out of 10. Let's say for solar farm, the costing, it got 8 out of 10. For wind farm, it got 7 out of 10. Or the hydroelectric power plant, it got 6 out of 10. Or for the other criteria like expected revenue, solar got 9 out of 10. Or the wind farm got 6 out of 10. Or hydroelectric plant got 8 out of 10. So these all scoring will be added, and then projects will be ranked on the basis of the total scoring in the next step. Based on the ranking, the highest scorer project will be selected. Let's assume that in our example, the solar farm project got the highest score. It got 55 out of 100, and the wind farm got 45 out of 100, and the hydroelectric plant got 42 out of 100. So the company will go for the solar farm project. So next step, it will develop the business case. So business case is a document that justifies the start of a project. It will provide all the necessary information to make an informed decision about whether to proceed with the project. So it will include the project problem statement and project objective, benefits and risk, and financial analysis, and what will be the implementation plan, stakeholder analysis. So all the details information will come under this business case. Then the final step would be the approval and initiation process. So this business case will move to the approval and initiation phase. The key stakeholders, including senior management and project sponsor, they will review the business case and they will evaluate its feasibility, alignment with the organizational goals, expected benefits, cost and risk. Then once they are agree, then the project charter will be created. So project charter is a formal short document that states a project exists, and it provides project managers with a written authority to begin the work. Next topic is economic measures for project selection. The very first term is return on investment, ROI. ROI measures the profitability generated by a project relative to its initial cost or investment. It's a percentage indicating the efficiency of the investment. Formula for ROI is net profit divided by cost of investment into 100%. We try to understand the ROI with a simple example. Just assume a company spent $10,000 on a marketing program and it generated 100 sales at an average price of $100 per sale. The gross profit margin for the company is 50%. So we can calculate the ROI. So 100 into 100 is 10,000. That will be the total sales volume. It's not the profit. Profit is 50% of 10,000, as the profit margin is the 50%. So it will come 5,000, which is the total gross profit. So ROI will be 5,000 divided by the initial cost. It was 10,000 into 100%. So ROI for this marketing initiative will come 50%, which is indeed a very good investment. If we have to select one project out of 3 or 4 projects given, so we can calculate the ROI for each one of them and then can compare and finally can decide to go for the project which have the highest ROI. But here one question arises: what should be the minimum ROI that a company should consider to go for that project or not? So it depends on several factors like cost of capital. So we call it WACC, the weighted average cost of capital. It is the overall cost of a capital from the all sources, including equity, debt, or any other financing. So it represents the average rate of return a company is expected to pay to its investors for using their capital in the business. The minimum ROI should at least cover the company's cost of capital. For example, if a company's weighted average cost of capital is 8%, so the minimum acceptable ROI should be higher than 8% to ensure that the project should add some value to the company. Next factor is risk tolerance. So projects with higher risk should offer higher returns to compensate the increased uncertainty. If a project is considered riskier due to the technological or regulatory uncertainties, so the company can add 4% risk premium to its WACC. So now it should look for the minimum ROI of 12%. Next is industry standard. So benchmarking against industry standards, it can provide the guidance on the expected ROI. Normally, in the large scale projects like power plant projects, the ROI are ranging from 10% to 15% due to the high capital cost and regulatory risks. Strategic objective. The company's strategic goal can influence the minimum ROI. For example, company might accept a lower ROI for the projects that align with the long-term strategic goals like sustainability or the market expansion. Market condition, economic and market conditions also play a crucial role. During periods of, let's say, the low interest rate, so acceptable ROI might be lower. Whereas in high interest rate environment, the ROI should also be higher. And alternative investment. If let's say the minimum ROI which company is eyeing for should be compared with the returns available from the alternative investment. If a company can achieve a higher ROI with lower risk with other investment, so then it will definitely consider whether to go for this project or not. So these all are the factors what should be the minimum ROI for the company uh, so that it should go for that project or drop it. Next financial term in project selection is present value. Present value is the current value of future cash flow or stream of payments. It takes into account the time value of money, which assumes that a dollar received today is worth more than a dollar received in the future because of its potential earning capacity. So we can calculate the PV with a simple formula that is FB future value divided by 1 plus R whole to the power n. So R is here discount rate or interest rate and n is number of time periods. Here is a simple example. Suppose we expect to receive the $1,000 in 3 years and the discount rate is 5% per year. So the present value we can calculate with the formula is 1000 divided by 1 plus 0.05 whole to the power 3, which will give us the value $863.84. So what it means, it shows the $1,000 received in 3 years, its value as on date is $863.84. PV calculation helps us in investment decision making by showing the current value of future cash flows. If the PV is higher than the initial investment, the investment is good because it promises more value than its cost. So it allows investors to compare the investment with other opportunity or spending the money now if there is no benefit. Loan and mortgage calculation. The borrower can check the present value of the mortgage payment he will do in couple of years. So this will help the borrower to assess the true cost of the mortgage, and he can compare the different loan offers he is getting from the different banks. Future saving goals. By calculating the PV of desired retirement income, one can set the realistic saving goals and how much he has to save today to get that particular amount in future. Business valuation. PV allows us to determine the current value of expected future cash flows, which is crucial for assessing the overall value for business. Next important financial term in project selection is net present value, NPV. NPV is a financial metric used to evaluate the profitability of an investment or project. It represents the difference between the present value of cash inflows and the present value of cash outflows over a period of time. In simple terms, NPV tells us how much value an investment will add to a business. So the simple formula to calculate NPV is sigma of FBT divided by 1 plus R whole to the power n, where FBT is future value at time t, R is equal to discount rate or interest rate, n is equal to number of time periods. We take a simple example to understand it. Suppose to start a business, there is a requirement of initial investment of $100,000 and expected return in 3 years. In first year is $30,000, second year $40,000, and third year $50,000. We assume the discount rate is 8%. So first we will calculate the PV of each year cash flow. So for year 1, PV1 will be the FBT divided by 1 plus R whole to the power n. FBT is 30,000 divided by 1 plus 0.08 whole to the power 1 because n is equal to 1. So value we are getting here 27,778. Similarly, for year 2, it will be 40,000 divided by 1 plus 0.08 whole to the power 2 because n is equal to 2. The value we are getting here 34,292. For year 3, 50,000 divided by 1 plus 0.08 whole to the power 3 because n is equal to 3. So amount here we getting is 39,701. So we will calculate the PV total by adding PV1, PV2 and PV3. The amount here we are getting is $101,771. We can calculate NPV now because we have the PV total and we have initial investment. So the amount we will get will be $1,771. So it's the positive value. So what it shows, positive NPV means investment is profitable. And if NPV comes in negative, so it means net loss. Next financial term is internal rate of return, IRR. IRR is the rate at which the amount of the money we put into an investment equals the present value of the money we get back in future. It's like finding the magic interest rate where investment neither makes a loss nor a profit. The IRR is the rate at which the NPV of cash flows is zero. In last slide, we saw the formula of NPV. So NPV is equal to sigma of FBT divided by 1 plus R whole to the power n. So here, as per the definition, we will put NPV as a 0. So let's take a similar example. Suppose to start a business, there is a requirement of initial investment of $100,000 and expected return in first year is 30,000, in second year 40,000 and third year 50,000. The discount rate is R%. That is the internal rate of return we will find out. Cash outflows as an initial investment is 100,000. The value will be in minus because it's going out from business. Cash inflows, what we are getting in future. So we will calculate the present value of what we are getting in future. So in year 1, PB1 will be 30,000 divided by 1 plus R whole to the power 1. In year 2, PB2 will be 40,000, 1 plus R whole to the power 2. PB3, 50,000 divided by 1 plus R whole to the power 3. So we will calculate the IRR with the formula of NPV. So 0 is equal to minus 100,000 plus PB1 plus PB2 plus PB3. With this equation, we can find out the value of R, which will be the internal rate of return. So high RR, generally a high RR indicates a more profitable investment. It means that the project is expected to generate returns at a higher rate. If we are getting low IRR indicates a less attractive investment as it suggests lower profitability. So we can select the projects accordingly. If we had 2-3 projects, we can calculate the IRR, and according to the IRR value, we can go for the higher IRR project. Next financial term is payback period. Payback period is a financial metric that measures the time it takes for an investment to generate an amount of cash flow equal to the initial investment cost. Means how soon we are getting our investment. In simpler terms, it's the amount of time it takes for an investment to pay for itself. So there are two kind of situation can happen. One is even cash flow. So in this case, it's very easy to calculate the payback period is equal to initial investment divided by annual cash inflow. What is even cash flow? It means if let's say we invested $300 and every year we are getting the equal amount like $100 in first year, $100 in second year, $100 in third year. So payback period is very easy. Initial investment 300 or the annual cash flow 100. So in 3 years. So the payback period will be 3 years because it's the even cash flow condition. What about there is uneven cash flow? So we will calculate the sum of the cash flow till the initial investment is recovered. So let's take the similar example. We are investing the $100,000 and our expected return in 3 years is 30,000, 40,000 and 50,000. So we will calculate the cumulative cash flow here. You see in year 1 the cash flow is 30,000. So at the end of the year 1 cumulative cash flow is 30,000. In year 2 the cash flow is 40,000. So cumulative cash flow is 70,000. So now we are short of 30,000. So what will happen in third year? In third year, remaining amount to be recovered is 30,000. So third year inflows here it shows 50,000. So we will average it out. So we need only 30,000 to recover. So 30,000 divided by 50,000. So it will take about 0.6 years. So if we calculate the total payback period for our invested amount of $100,000 is 2.6 years. So that's how we calculate the payback period for an investment. Next important financial terms in project selection are cost benefit analysis and cost benefit ratio. Cost benefit analysis CBA is the process of comparing the estimated cost and benefits related to the project, whether it is profitable or not. Cost benefit ratio CBR is a metric derived from CBA that expresses the relationship between the cost and benefit of a project. It is a fraction of total benefits and total cost. So we can calculate CBR by total benefit divided by total cost. If CBR is greater than 1, it shows that the project is profitable. Let's try to understand the both concepts with a simple example here. Setting up and operation of 50 megawatt solar energy project, and the project duration including operation is 20 years and discount rate is 5%. So let's try to understand the cost and benefit. The breakdown is given here in these two tables. Direct cost. So what will be the direct cost? The initial investment and the annual operating cost. So under initial investment, solar panel and inverter cost is $50 million. Land acquisition will be $10 million, and installation cost will be $5 million. So if we sum up all these, so direct cost will be $65 million. Come to the annual operating cost. So maintenance cost is $1 million. Manpower cost is $0.5 million. So, and in annual operating cost, we will add the indirect cost. What are the indirect costs here? The environmental impact assessment annually means you have to carry out the assessment. What is your project is impact, how your project is impacting the environment. So the cost will come up around 0.1 million. And disposable of old batteries and solar panels. So the cost is around 0.1 million. So if we add, so this indirect cost will be 0.2 million. And if we add direct and indirect cost, so total cost, direct plus indirect, will be 66.7 million for this project. Come to the benefit table. So the benefits are also direct benefit and indirect benefit. So direct benefit, annual revenue from electricity sales, so $15 million. Tax credits and incentives given by the government for the green energy, so $2 million. So total direct benefit will be $17 million. Intangible benefits will also be there. The improved company reputation for sustainability, increased energy security for local community. And indirect benefit will be the job creation. Annually you are giving the job to the community people, around worth of $1 million, and reduced carbon emission annually is $0.8 million. If we sum up all these, so total benefit direct plus indirect will come to $18.8 million. So come here now, initial cost is $65 million. This is the present value initial cost. Now we are investing. Annual operating cost $1.7 million. It's the future cost. And annual benefits, this also future benefits. So what we will do, okay, this is the formula for the present value of an annuity. Annuity means we are calculating the present value of the future cash flows, and we are summing up all the present values of every year up to the 20th years, because the project duration is 20 years. So we derive the formula here. PV is equal to C into 1 minus 1 plus R whole to the power minus N whole divided by R. So present value of annual cost, because this annual operating cost is 1.7 million. This is the future uh, gain, future fund. So 1.7 we will put here, and then the value we will get here $21.2 million. We have to calculate the present value of annual benefits. So what we are getting in future, so it's 18.8 annual benefits. So we will calculate the present value for this future value. So it's coming $234.3 million. So now we have all the values. What is our present initial cost? What we are investing today, it's a $65 million. And what is the present value of annual operating cost? It's $21.2 million. And what is the present value of annual benefit? It's $234.3 million. So if we have all three values with us, so we can calculate the NPV PV benefits minus PV initial cost plus PV annual cost. So NPV is coming up 148.1 million. It means it's in the positive side. So our project is in a good sense. Similarly, CBR we can calculate 234.3 divided by 86.2. So we calculate, so it's giving the value of 2.72. Here we have mentioned earlier, if CBR is greater than 1, it means the project is profitable. So based on the NPV and CBR, our solar energy project appears to be highly profitable and beneficial. So this is the summary slide for all the financial terms we discussed so far in previous slides. Here we can see the terms ROI, PV, NPV, IRR, payback period, CBA, CBR. It's very handy list. So we can go through once again. So ROI, return on investment, measures the gain or loss generated on an investment relative to its cost. So if a project has a high ROI, it means the project is generating a significant return relative to its cost. For example, the ROI of 20% is better than a ROI of 5%. So value type always is shown in percentage. PV, present value, the current value of future cash flows discounted at the appropriate discount rate. So higher PV means the value of future cash flows is greater when brought to today's value. For example, if PV of future cash flow for a project is $200,000, it's more beneficial than a project with a PV of $100,000. NPV, net present value, the difference between the present value of cash inflows and outflows over a period of time. Positive NPV, it indicates that the projected earnings exceed the anticipated cost. For example, if the NPV is $50,000, it suggests profit. And if NPV is showing in minus $10,000, it will suggest a loss. IRR, internal rate of return, the discount rate that makes the NPV of all cash flows from a particular project equal to 0. So a higher IRR means the project is expected to generate a better return. For example, if a project with an IRR of 15% is more attractive than one with an IRR of 8%. So it will always shown in percentage. Payback period, it's the time. It will shown in years or month. So the time it takes for an investment to generate cash flows sufficient to recover the initial cost. A shorter payback period means the investment recovers its cost quickly, reducing the risk. For example, a payback period of 3 years is far better than the 7 years. CBA, cost benefit analysis, a process by which business decisions are analyzed weighing total expected cost versus total expected benefit. If the benefits significantly outweigh the cost, the project is considered beneficial. For example, benefits of $500,000 against cost of $200,000 indicates a good project. CBR, the ratio of the present value of benefits to the present value of cost. So a ratio above 1 indicates that the benefits outweigh the cost. It suggests a good investment. For example, a CBR of 2.5 is far better than a CBR of 0.8. So that's all for now. I hope you have enjoyed the content and the delivery. Let's take a short break and I'll return soon with more project management material. Before we part ways, I'd like to ask you to kindly show your support by liking and subscribing to my channel. Your engagement means a lot to me. Namaste, goodbye, Sampai Jumpa.